you were to categorize what we're seeing, are we still in a disinflationary environment or an inflationary environment?
Well, if you don't give me the option to say we are in a normal inflation environment, that's how I talk about it. We're still in a disinflation.
What is normal inflation environment?
Well, inflation back at 2% everywhere. Inflation back at central bank targets. I think that's what we're going for right now. Because if you look what's happening in the background is output gaps around the world have essentially closed. We've moved from a world of excess supply, which was deflationary and depressed business investment over the last couple of years, to one where output gaps are closed, so demand and supply are more in balance. And in that environment, you see a pickup in business investment, which is behind the global story that Terry talked about. And it's also behind this gradual push-up in inflation back to normal. But we don't see anything that will push inflation to levels where it becomes a market issue or where it forces central banks to accelerate any rate hike plans they may have.
Terry, at 40,000 feet, isn't there a simple explanation for what's going on, whether it's century bonds at low yields or whether it's the equity markets? And that is central banks, developed market central banks, have pumped trillions of dollars, euros, yen into this marketplace. And by the way, all the assets have gone up. That's not very surprising. And at this point, it almost is hard to get diversified because those dollars and euros and yen have creeped into just about every part of the economy. Is that a problem in and of itself?
It's a problem in the reality that if you think about this from an asset class perspective, multi-asset perspective, is that all evaluations have been pushed higher from quantitative easing policy. So we've compressed risk premium across the board. It's not just equities. And that's why when investors ask us equities versus bonds and say, like, we should get out equities, well, we say, like, much better valuation opportunities relative to bonds. But as some of this normalization takes hold from the Fed and potentially ECB next year, we should see a reversal of some of that. But the idea is that it's going to be so gradual that these policymakers do not want to basically disturb some of those forces, and there will be an adjustment, but we don't see that adjustment being very, very large, at least at the outset.